Good morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, September 27th. I'm recording this on Sunday afternoon, the 26th, having just returned from 3 days in New York, 2 days in New Jersey. S&Ps are up 15 handles as we're recording this. Market seems to be in one of those situations where we just had a Fed meeting and equity investors are feeling somewhat euphoric about the fact that the taper, we have another month's reprieve before the taper begins, but yet rates are moving fairly aggressively higher. And in so many ways, this is reminiscent of what happened in 2018 when we were going through balance sheet runoff. We think it'll catch up to equity investors. So the title of the note this week was called Inflections, and it refers to the four inflection points we believe we're going through, all of which are negative. Growth has peaked. It'll slow. It won't be slow, but it's slowing on balance, notwithstanding the ebbs and flows around the latest round of the pandemic. Monetary policy is inflecting negatively, obviously. We're going to talk about that a bit in this discussion. Fiscal policy is inflecting negatively despite seemingly the battles between the progressives and the moderates or less progressives in the Democratic Party. They are going to raise taxes one way or another, and liquidity is inflected negatively. So 4 sections to the note this week: a market recap, actually 3 sections, excuse me, a bit of a market recap and data recap, discussion of Fed policy, and then a little bit of an insight into the meetings we had back in New York and some of the discussions about financial sector disintermediation and the energy sector. Those 2 sectors dominated our discussions back in New York last week. So first on the markets, the thing that occurred to us as we were discussing Evergrande at the beginning of the week with investors is that this idea that there's going to be a Lehman moment that will permeate out through the systems, we think has causation wrong way around. We actually think that what's going on, part of the reason why this situation that had been well known for quite a number of months is starting to bubble up to the surface is because global liquidity is tightening. And you can see that in the movement in real rates or TIPS yields. 2-year real rates have rallied 45 basis points from their late July low. 5-year real rates are up 37 basis points. 10s are up 31. 10s moved 30 basis points twice quickly in 2018, once in January, and then Volmageddon came right after that, and then again in September, and we had the quantitative tightening crash. Now, the starting point was much lower this go around. Financial conditions are by no means tight, but rates are starting to move aggressively, being driven by real rates. This is not reflationary. When real rates go, that's a tightening of financial conditions. That's what's happening. If it extends into next week, we think it will catch up to the equity markets. So back to the Evergrande situation. This is why you have to be very careful with emerging markets, emerging market equities, emerging market debt when the Fed starts tightening, because as that liquidity starts to get withdrawn, and to be sure, the Fed's not about to start the process, but the Treasury General Account process has already inflected negatively. We went from $1.7 trillion all the way down to 200 billion. The latest week, it's back up to 300 billion. By all accounts, Treasury Secretary Yellen is going to want to rebuild that balance once there's a debt ceiling deal, and liquidity is going to start to tighten. So we have reached that inflection point, and it looks to us that the Chinese have outflow pressures like they had in 2015. Makes sense that they would have outflow pressures when the Xi regime is cracking down on corporate titans. They're obviously going to want to get their money out of there. And inflows from the West are undoubtedly slowing and are likely to slow, particularly as the Fed tightens policy and this whole Treasury General Account process starts to work in reverse. So that's how we're thinking about that at present. Clearly, real estate fundamentals are terrible in China, worse than they were in the U.S. Back in 2006. We don't, again, think there'll be a big financial crisis. They're not going to do something as foolish as Hank Paulson did, where he decided to make Lehman Brothers his political sacrificial lamb. Nonetheless, the fundamental situation there is not good. Again, we wouldn't touch Chinese equities. So looking at the flash PMI numbers last week, you could see a little bit of that inflection point, not so much in Australia or the US, where we're reasonably energy independent. We think energy is part of the story and reason why things are starting to, at least the PMIs are struggling in Europe or started to come off their highs at least. Natural gas prices are exploding in Europe. And this is going to be an ongoing problem in the US as well. I mean, a cold winter and crude is over $100. I think that's pretty widely acknowledged. I know Bank of America strategist has talked about that. That's a reasonably probable outcome. We've dug ourselves a little bit of a hole here. So the reaction again to the Fed was something of relief on the equity markets, but as these real rates keep going up, and even tonight they look like they're biased to go a bit higher, that will catch up to the equity market, and we do think that correction we expect. We were down 5, we bounced from down 5. We still think we're going down at least 10 before all is said and done with respect to this. So on to Fed policy. Chairman Powell described the labor market as all but having achieved their substantial progress goal. We wrote about this 2 weeks ago. Fed President Williams' speech really was a bit of a seminal moment when he declined to talk about a benefits cliff or caregivers still struggling to go back to work, and instead said labor demand is fine, we have a supply problem. We knew then that the Fed, because for us, he represents the dovish wing of the Fed, we knew then the Fed was over the hurdle on the labor market. The thing, though, that really pushed the dot plot up and moved liftoff from 23 to 22, and the 23 forecast for the Fed funds rate from 60 basis points to 100 basis points, we still think they'll be behind the curve, but they're sounding increasingly hawkish, is that the team transitory within the Fed is losing credibility. We've written a lot about this. Supply chains are not clearing. Housing-related inflation still looks ridiculous. It's going higher. This inflation surge is not transitory. And Chairman Powell's characterization of 2022, inflation forecasts are 2.3 and 2.2 on core and headline, we thought that was a little disingenuous. In 2021, you were ignoring the base effects, but in 2023 or 2022, you're going to take advantage of the base effects to say we're back to goal. No, not really. And we probably won't get that low in our view anyway. So this inflation problem is going to persist. We love our 60s analog. If you haven't read the essay on that, it's on the front page of our website. You should go have a look at it. This is where we think we're going to be once the Fed gets started with this. They're going to be persistently or consistently behind the inflation curve through this business cycle. That's it on the Fed. Finally, final section, we called it reflation regime, but really what we wrote about was our discussions in New York, and it was quite fascinating for us, particularly in the financial sector. We spoke with a number of former colleagues and competitors who have moved on from the big banks, and they're working at firms that are dominating trading now, that are non-traditional Wall Street investment banks. We went in to see a big crypto trading firm. The smartest, best and brightest derivative-based people that we know, and that was our background, have moved on from the big banks in a lot of cases. And this doesn't bode particularly well for the street in terms of innovation. I do think the group is still worth owning. I do not, though, think that the group is going to be at the vanguard of innovation within the financial sector. And the progressive agenda is helping to really accelerate that process. The more that the Elizabeth Warrens and AOCs of the world want to penalize the big banks, the more that the innovators within the big banks want out of the big banks, and the less control regulators will have over the financial system. So well done, progressives. If that's what you wanted, you're succeeding. We also had quite a number of discussions in our meetings about commodities and energy in particular. And the meetings left us just very bulled up on the energy patch. It's very clear this ESG agenda, the policy agenda, the Biden administration all these things are conspiring along with, an oil sector that went through a supply shock last cycle, is focused on stable return on invested capital. And this sector, we just think is going to work. It's a small sector right now, but we would have some decent sized positions in it because we do think it is likely to be a big winner this business cycle. So that's it. We'll be back to our regular publishing schedule. We're going to be around Colorado for the foreseeable future. So if anybody wants to discuss any of this with us, by all means, drop us a line. Barry Knapp, Ironsides Macro. Have a good week, everyone. Thank you.